Well, there's been a lot of talk lately about the Strait of Hormuz and whether this latest U.S. Iran escalation is about to send gold and silver straight into the stratosphere. So, in this video, we're going to separate what's emotional from what actually matters. And you are going to walk away feeling a lot smarter and a lot more prepared for what could happen next. Today is Monday, April 13th in New York, so go ahead and tell me the day and date you're watching from down in the comments. And if you value my work here, support the channel by subscribing and commenting John A.G. Best. That really helps, because the way this story is being talked about right now, it sounds simple. Talks failed. Trump came out swinging. The Strait of Hormuz is back in the center of the map. Oil jumps, fear jumps. Therefore, gold up, silver up, done deal. That's the easy take. But easy takes are usually where people get themselves in trouble, because markets don't move on slogans. They move on liquidity, positioning, expectations, and timing. And when geopolitical stress collides with oil, inflation, the dollar, and interest rate expectations, the first move can look very different from the move that comes after it. So let's walk through this carefully. High-level talks between the United States and Iran were held in Islamabad, Pakistan. They ran for roughly a full day. No final agreement came out of them. The U.S. side came away saying Iran would not cross the nuclear red line Washington wanted crossed. The Iranian side came away saying Washington still had not earned trust. That is not a recipe for calm. And once those talks ended without a deal, the next headline was bigger than the meeting itself. Trump announced a blockade move tied to the Strait of Hormuz. Now, here's where you have to be precise, because a lot of people are going to oversimplify this. The early rhetoric sounded like a much broader, strait-wide shutdown. But the U.S. military later clarified that the action would apply to ships going to and from Iranian ports, while transit between non-Iranian ports through the strait would still be allowed. That distinction matters. And even with that narrower clarification, this is still a major escalation. Why? Because the Strait of Hormuz is not just some random waterway people point to on a map when they want a dramatic thumbnail. It is one of the most important energy choke points on the planet. Based on official U.S. energy analysis, flows through Hormuz recently accounted for more than a quarter of global seaborne oil trade, about one-fifth of global oil and petroleum product consumption, and around one-fifth of global liquefied natural gas trade. So when that route starts appearing in military headlines again, the shock does not stay local. It leaks into everything. That is why oil ripped higher almost immediately. From current market reporting, crude surged back above the $100 area after the blockade announcement and after the collapse of the talks. And that makes perfect sense. Energy markets do not wait around for perfect certainty. They reprice risk the second supply disruption becomes even vaguely believable. Shipping companies get nervous, insurers get nervous, buyers get nervous, refiners get nervous, and when enough nervous people are tied to the same choke point, prices move. Fast. Now here's where the precious metals crowd needs to slow down and take a breath. A lot of people hear geopolitical danger and assume gold and silver must explode higher immediately. Sometimes they do, sometimes they don't. In fact, sometimes the very first reaction is the opposite. Because in the opening wave of fear, money often runs first into the dollar and cash-like safety before it runs into metals. That is exactly the kind of cross-current the market has been showing today. Current reporting shows the dollar strengthened after the failed talks, while gold slipped and silver weakened as oil moved up and traders pulled back on hopes for Fed rate cuts. That's the setup a lot of people miss. If oil jumps, inflation fears wake up. If inflation fears wake up, rate cut hopes get pushed back. If rate cut hopes get pushed back while the dollar is catching a fear bid, metals can struggle in the short term even if the bigger picture later turns constructive. That is not a contradiction. That is how markets actually behave. And silver especially tends to turn this into theater. Gold can be moody, silver can be dramatic, silver gets sold when people need liquidity, silver gets dumped when traders get nervous. Silver can look broken right before it remembers what story it is supposed to be telling. So if silver gets hit first, that doesn't automatically mean the longer-term case is dead. It may just mean silver is being silver. Reporting around the Islamabad meeting says the Iranian side came in with a list of hard demands, including issues tied to frozen assets, reparations, influence over Hormuz, and a wider regional ceasefire. I would be careful about treating every line of that as gospel fact from both sides, but the broad picture is consistent across current reporting. The distance between the two positions was still very wide. The U.S. wanted a harder commitment on the nuclear issue. Iran wanted concessions and security terms Washington was not ready to accept. So when people say the talks failed as expected, I understand why they say it. The gap was not small. And there is another reason this matters. The meeting itself was historically significant. It was described as the highest-level direct U.S.-Iran contact since the Iranian Revolution era. When a meeting that high up cannot produce an agreement, markets start asking a different question. Not, did the talks go well? But what tools are left if talks are no longer enough? That is when headlines get sharper, military language gets louder, and market reactions become less forgiving. Now I want to challenge one lazy assumption floating around out there. The lazy assumption is that this automatically means all-out uninterrupted escalation from here. Maybe, but not necessarily, because a blockade headline can serve more than one purpose. It can be operational, it can be coercive, it can be diplomatic pressure and military clothing, it can be designed to squeeze exports, squeeze leverage, and force the other side back toward the table under worse conditions. Analysts quoted today were already split on whether this was mainly a bargaining weapon or the beginning of something larger. That tells you the situation is serious, but it also tells you the future path is not settled. So I do not think the smartest view here is blind panic. I also do not think the smartest view is complacency. The smartest view is probably that the market now has to price a wider range of outcomes, and wider ranges create volatility. That means you could absolutely see a sharp move lower first in gold and silver, especially if the dollar stays firm and the market keeps treating this as an inflation and rate story before it treats it as a hard asset story. That's plausible. In fact, current market coverage already showed gold near a one-week low with silver under additional pressure, while oil surged and the dollar firmed. But that is only the first layer. Here is the second layer. If oil stays elevated for more than a quick panic burst, then the macro picture gets uglier. Higher energy costs bleed into transport, logistics, manufacturing, consumer expectations, and headline inflation. Central banks get less room to cut, growth expectations get squeezed, risk assets start feeling the pressure from both directions. And once markets start realizing this is not just a military story but a broader policy stress story, that is when gold can begin to recover its footing in a much more serious way. In other words, the first move in metals and the more important move in metals may not be the same move. That distinction could make you a lot of money or save you from a bad decision. And let me add some fresh context that matters here. This war and the earlier disruptions already changed how energy traders think about the Gulf. Recent reporting suggests Iran's ability to disrupt Hormuz during the recent conflict shattered a long-standing taboo and exposed just how vulnerable regional energy infrastructure is. That means even if this specific blockade situation cools down, the psychological damage to the energy map does not just disappear overnight. The market has now seen what this choke point can do under stress. Once a market sees that, it doesn't unsee it. That's important for gold. Because gold does very well when confidence in the plumbing starts to crack. Not when people merely get scared for 10 minutes. Not when a headline flashes and disappears, but when investors start asking whether the system underneath them is more fragile than they were pricing in. That is where gold becomes more than a trade. That is where it becomes insurance. Silver can benefit too, but silver usually takes the scenic route. It likes to throw people off first. So what am I expecting in the near term? I think oil and gas stay under upward pressure unless the rhetoric cools quickly. I think the dollar can stay supported near term if fear remains the dominant emotion. I think gold and silver can absolutely get hit first or stay soft first before the larger inflation and stability questions bring them back into focus. And I think if metals do slide on the opening reaction, there is a decent chance that move becomes a buying opportunity rather than a reason to panic. Notice what I said there. A chance, not a guarantee. Because one of the biggest mistakes investors make in situations like this is acting like market psychology is some clean equation. It isn't. It's messy. Sometimes the first sell-off is forced liquidation. Sometimes it's genuine bearish conviction. Sometimes it's both. Sometimes markets overshoot downside, bounce hard, then test again. And when that happens, people confuse noise for truth. Don't do that. If you're successful, share your success story in the comments so others can stay motivated. Because a lot of people are trying to get better at staying patient in high volatility environments, and hearing from someone who learned not to chase every move can help more than you think. Now let me come back to one more point that deserves real emphasis. This is not just a metals story. It is an oil story. It is a dollar story. It is an inflation story. It is a shipping story. It is a central bank story. And until you see how those pieces connect, you can't really understand what gold and silver are reacting to. Oil higher can hurt metals first. Dollar stronger can hurt metals first. Fading rate cut hopes can hurt metals first. But the same forces, if they persist, can later become the very reason investors rotate back into hard assets. That is the trap and the opportunity wrapped into one. So no, I'm not in the camp that says this automatically means instant moonshot for gold and silver tonight. And no, I'm not in the camp that says a short-term dip means the thesis is dead. I think the more honest read is that this situation raises the odds of short-term turbulence, short-term confusion, and potentially short-term downside in metals before the bigger market consequences become easier to price. That's the lane I'm in. I'm watching whether oil holds above the century mark. I'm watching whether the dollar keeps pressing higher. I'm watching whether gold finds a floor after the first emotional reaction. And I'm watching silver like a hawk, because silver usually tells you when fear is still in charge and when the market is finally starting to look through the smoke. One more thing on the shipping side, because this is where the details matter. Current reporting says traffic through the strait had already been badly disrupted before this latest announcement, and the United Kingdom's Maritime Monitoring Center said there had not been any meaningful recovery in traffic after the ceasefire. So this is not a normal market being disturbed by one new headline. This is an already fragile transit route being hit with another layer of pressure. That changes how traders frame risk, and Iran's response tells you this is not being treated as a symbolic spat. Iranian guards said military vessels approaching the strait would be viewed as a breach of the ceasefire, while Iranian officials insisted the waterway remained open only under their rules. That doesn't guarantee open conflict, but it tells you both sides are using language markets cannot ignore. That matters for another reason too. When the energy market sees not only disruption but contested authority over a choke point, it starts adding a political risk premium on top of the physical supply premium. And those are two separate things. One is about barrels, the other is about confidence. Confidence can vanish a lot faster than barrels. That is why I think a lot of people are underestimating the second round effects here. Even if the blockade stays limited to Iranian port traffic, the message to the wider market is that the region remains one headline away from another major repricing event. That can affect airline costs, freight rates, inflation expectations, and broader equity sentiment well beyond the energy patch itself. So when you ask, what does this mean for gold and silver? My answer is that it first means you have to respect the chain reaction. Energy shock can become inflation shock. Inflation shock can become policy shock. Policy shock can become growth shock. And when growth shock starts colliding with distrust in the stability of the global system, that's when precious metals usually stop being background decoration and start becoming central again. The only hard part is the timing, and timing is where people lose discipline. They get the big picture right and the sequence wrong. They understand where the story may be heading, but they can't tolerate the ugly route the market takes to get there. That is why patience matters here. And if the market gets whipsawed between fear, inflation, and diplomacy headlines, don't be shocked if the first 2 or 3 moves tell completely different stories before a real trend finally takes hold. So stay calm tonight. Stay selective. Don't let a dramatic geopolitical story force you into a lazy trade. This is a serious situation. It deserves serious thinking. And just remember, educational perspective only here. I'm sharing how I'm reading a fast-moving market and a geopolitical setup, not giving you personal financial advice. So do your own homework before making any move.